You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. So be sure to check out our live stream via the Mixlr app, or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by QuickStrike, options pricing and analysis software. Learn more about QuickStrike at bantix.com. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. Visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. For more information, please visit ftserussell.com. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That music means it is time once again for TWIFO, This Week in Futures Options, a program where we break down all the fun stuff going on the other side of the fence. Maybe you like yourselves a little bit of ags, a little bit of metals, a little bit of crude, a little bit of, who knows, FX, equities. It's all in there. It's all stirred into the tasty stew that is TWIFO. My name is Mark Longo. If I sound like I'm back to my old self, it's because we're back here in the Chicago studios, out of the path of the raging hurricane, even though our thoughts are with everybody out there who's still dealing with the aftermath. Seems like it's mostly staying off the coast, which is beneficial. No landfall, at least not yet. So that's at least something to be thankful for. But hopefully we'll give you a little dose of TWIFO to lift your spirits. And joining me to help me do just that, it's been a while since we had him back in the old CME Group hot seat, but he is back once again. He is the rock lobster himself, Mr. Andrew GIOVINAZZI from OptionPit.com by way of Carmen Line Capital. Mr. G, welcome back to that hot seat. How is it? I turned up the heat for you there. Is it a little squirmy? Is it a little hot to the touch?
I have to say I'm feeling a little I'm parched. I'm a little parched. I'm a little hot. A little a little worrisome. Everything, little worries. I got worries here. I got worries there. A little hot. And I'm on the hot seat to boot. So I got all kinds of problems.
It's not fun if it's not a little bit worrisome, right? I mean, we designed it. It's not called the comfy seat, right? It's called the hot seat. So you
correct.
You got to squirm. It's like the Iron Throne. You got to squirm on it a little bit. You can't just sit on it. It's not pleasant to sit on. Our buddy Sean is over there. I believe he's at the Risk Management Conference over there in Europe this week. So he'll be joining us again, I believe, in the studio next week, hopefully with some tasty and delicious snacks in hand. Of course, you guys can play along, as always, the home game, cmegroup.com/TWIFO, TWIFO. You go there, you can select whatever products you like, including what's lighting it up this week. Let's break it all down here. It's a weird week. It's very upside heavy. You can find this for yourself, listeners, going on over to the cmegroup.com/TWIFO. Click on the market scans, and then you too can see what the big move. Make sure you set that date reference back to 1 week so you can see what the changes are week to week, not just otherwise it defaults to 1 day. But if you go out to 1 week, you'll see that the big movers, it's all upside action this week, and it's mostly metals. It's silver, number 5 of our top 5 here, up about 2.7%. Number 4, platinum, up 4.8%. Palladium, another name we talk about a lot here, 5.8% to the upside. Then nat gas, the lone energy name up there, up about 6%. And then iron ore. Iron ore has been rocking and rolling of late. You guys have asked us about it. We've tried to profile it here on the show. As we've said before, it's not really an options story. Not a lot to parse there from volume, but underlying it is up 11.2% this week. Well, let's go to the dark side. It seems like that's mostly ag-related. Number 5, we got wheat down 1.6%. Then live cattle down 1.7%. Number 3, KC wheat, so a lot of wheat on the downside there, down 2.5%. Lumber down about 3.15%. We had to go out to 2 decimal places because number 1, it was so close, was corn, down 3.16%. So a lot of ags on the downside, even though the downside isn't quite as stark as the upside is strong this week. Speaking of strength, Mr. Rock Lobster, let's start in this neck of the woods before we get into some of those others we just profiled, because this is kind of near and dear to your heart. I know you're mostly an equities guy and a volatility guy to boot, so we'll start in that realm because it is a weird week for that. We're seeing sell-offs, and then all of a sudden coming into today, all is right with the world again. All the major indices are up, and they're up pretty hard. S&P up pretty strong, Russ up pretty strong as well. In fact, coming into showtime here, let's start out in Russell land as we are wont to do out here. The RUT up, and the Russell 2000 E-mini options up, and the Russell 2000 in general up a little over 1%, a bit of a laggard to the other major indices that we've been seeing for a while. Russell's kind of marching to the beat of its own drummer this time today, and this week at least. It's kind of keeping in line with the rest of the market, up about 1% here on the week. Today's rally having a lot to do with that. Of course, a lot of green on the screen to end the week means a lot of red in the volatility space. VIX off quite a bit, off just down to 1575. That puts it off about 2.5 handles from our last show listeners. VVIX, aka the volatility of S&P volatility, also off, down about 6.5 handles to about 95. From our last show. And our old friend RVX, a.k.a. the Russell VIX, still elevated, though it's off quite a bit from last show as well, down about 1.25 handles to about 20.2. That means, for those of you who have been paying attention, that spread between VIX and RVX has widened out quite a bit. It was down to about 3 points not too long ago. Now it's up to about 4.5 handles, so it's widened out quite a bit. So let's start there. Mr. Rock Lobster, you are a man who spends his time knee-deep in the volatility trenches, coaching, analyzing, mentoring your folks over there at Option Pit, as well as, of course, helping to trade the vol space over there at Carmen Line Capital. What's lighting up your tape in broad S&P volatility, as well as, this ratio between Russell 2000 volatility and S&P volatility starting to get a little interesting. Would you agree, sir?
It is getting a little interesting just because it doesn't normally look like all this. We've got a Russell vol is still kind of, it is drifting a little lower with VIX. But, as far as both of them goes, it's not the Russell, the big thing is just lagged so far behind the S&P 500. So it's, I would just say here, I think it almost feels like people are waiting for the Russell to kind of spring back to life when it comes to the Russell and the VIX. That would be my, we call it spidey sense or whatever, but whatever that's worth. But it does look like they're trying to price some of that a little back. That would be my guess. As far as curve goes, just looking at sort of the near-term curve in SPX, There's a bid to like 29.50s. So basically, they're starting to price a little bit of the near downside a little higher in the short term, mostly because I think, we've kind of ripped through everything and liquidity providers sort of pricing that 29.50 strike, 29.40 strike. It's pricing a little higher because probably everybody's thinking of a pullback. We pull back a little bit and maybe some of the bloom comes off of this no trade deal rally that we have. I think that's definitely part of it to see if, I just, anyway, the way the curve looks like the markets, at least liquidity providers are expecting a little bit of a pullback from this fantastico rally.
And what is obsessing your volatility folks over there in your chat room these days? What are they on about? What's the big obsession that is driving them these days?
Well, one of the exceptions is destruction of all VXX puts prior to the last couple of days. That vol product, I think it's up on the year, which it's really not supposed to be, but I think let me see here. It's about even for the last 3 months. Let's see here, last 6 months. I think, okay, it started in the mid-30s, and what was it? It was just almost 30. So it's at that point now where, what is that number? I guess it's trying to touch its 50-day moving average. I don't say that very much, but it is about to break through, and let's see if it could actually get down and hit some of the lower numbers. And, basically we need VIX down to 13. I don't know if that's going to happen before any kind of a deal. So the dependability of VXX as a product is still dependably crappy. It's doing what it's supposed to do. As far as VIX as a 16, until the market stops moving over 1% a day, it's going to be hard for VIX really to start holding those like mid-15s or lower numbers. Just, because basically you can buy any contract on any day and the market moves 1% one way or the other. So it's hard for volatility really to go down when that's happening. So those liquidity providers, they're pesky things. They do look at actually what the market's doing and try to price the options accordingly. I know that's crazy for everybody that has all these conspiracy theories about how options get priced, but ultimately they just price it based on math and then see what the market brings.
What fun is that? Rational pricing based on mathematics and volatility and models. What fun is that, sir? It has to have some sort of conspiracy theory in mind. Speaking of conspiracy theories, a lot of people allege those about VXX all the time. Kind of an honorary futures option. It's not quite, but they're using effectively what causes all of the erosion in that product is the volatility futures curve. So as a result, it's pretty much an honorary. They're trying to replicate that future using different baskets as a result, and usually with middling success. Hence a lot of the issues we've seen out there with that product of late. An area, Mr. Rock Lobster, that hasn't had issues, and we were just joking with our friend Uncle Mike on our previous show about this. This is kind of his neck of the woods. This is the metals. The metals are kind of, as we just pointed out there in our movers and shakers there, pretty much all of the top 5, with the exception of nat gas, are all metals or metal-related products, like your iron ore, not exactly a precious metal, but still in the metals category. Then we got nat gas. Everything else, palladium, platinum, silver, we're all firmly in that metals camp. Let's start with silver, because that's kind of just been an impressive story to watch here. As, again, it continues this week, 1884 coming into showtime. That puts it up about nearly 2.75% here on the week, right around half a handle yet again. So silver outperforming gold remarkably of late. In fact, I think we have a question about maybe we'll cheat and bump that question up a little bit. But it has been fascinating to watch that come into showtime. Of course, silver vol. Remember, we've talked about the skew. The skew is clearly to the upside, because silver, continues to rally, and the vol continues to increase as well, particularly in some of those. Let's go out beyond 2 weeks. That's usually my barometer. That's a good question for you, Mr. Rock Lobster. We always try to parse here different, contracts on the show, and it's really hard for me to talk skew in a contract that has less, and volatility in a contract that has less than 2 weeks to go, because then you're talking mostly gamma, and the skew can swing around like crazy. So I kind of use 2 weeks as that kind of that Mason-Dixon line. I prefer a month or more, but 2 weeks is kind of good. Where do you have that line of demarcation for you where beyond that it's really just you throw it all out because it's all kind of gamma anyway?
I just go back to like trading the SPX because almost everything was 30 days back then, right? You almost had no, you had no, there were no weeklies or anything like that. So I think having kind of that rolling 30-day number, that's a very equity land-esque thing, especially because the VIX now has kind of popularized that. But I mean, short term, like, 2 weeks, 2 weeks and in a commodity, it's just, I would say it's different just because I'm always looking at equity indexes, just the amount of decay and stuff that just comes piling in an index in a week. I think if you're looking at this, you should stick to something though. So 2 to 3 weeks looking at the skew is pretty reasonable. But 1 month is just because it's an on cycle time, and that's what for me anyway, that's what I look at. After 1 month, those vol curves don't move a ton out there. And they move quite a bit in, let's say, the 1 to 2 week time frame. So you're trying to pick on what part of the movie you're trying to play, right? Are you trying to play the beginning part where, like you said, there's a lot of gamma short term, and then you're trying to sell all that out of the money stuff against it and see if you get anything, and you're kind of racing against decay, or you're trying to do something more risk reversally, or trying to play like a longer term trend for vol in a commodity. So the only thing I could think with silver though is because it's gone straight up in the last month. I can't remember the last time I saw silver do this. So the only thing I can think of is are the Chinese just buying a bunch of precious metals now because they don't feel like buying treasury bonds anymore? So I'm not sure what caused this giant run, but it kind of feels like, I guess it's partly dollar, but this is the kind of stuff that makes the skew go bonkers, I guess, as far as
yes,
and metal.
Yes, definitely. I think bonkers is a good way to describe it. Let's break down some of that skew. Like I mentioned, the vol up as we keep moving farther up the skew chart here. The calls are where the action is, and so vol goes up. Those of you who were asking last week about shifting and sliding on the skew curve and what that means, we're kind of sliding along that silver skew curve right now, and as a result, we're seeing there's a bid to the upside, and vol keeps increasing. That's pretty much what you'd expect here. Let's go out to October. It gives us right around 20 days, so that's a nice, reasonable amount of time. And the vol in that contract up quite a bit yet again, up nearly 6 handles just this past week. So vol getting a nice lift as we continue to rally out here. If you're wondering where the action is, it is to the calls. Like we said, the calls were nearly 15% rich to the at the money last week, about 14.7%. Actually coming in a little bit down to 13.9%. I guess some of that, if they were so outlandishly bid as we move up a little bit, not surprising to see some of that come in a little bit. Puts staying the same. They're about 8% cheap to the at the money this week versus last week. So not much change on the put side. Calls where the action is, if you go a little bit farther out, let's go out to November, same deal, about a point on the calls. About a point and a half actually on the October calls. So the slow slide up, maybe not that slow, but decent slide up. It continues, but it's not an explosion. So we're seeing vol up, but not through the roof out there as those farther points of the call skew, the call wing coming in actually a little bit. In terms of where the action was, it was calls, and it was this week out here in DEES. Actually, it was the DEES. 21 calls leading the charge, 5,635, the lion's share on Wednesday, about 3,000 going up there. Then the 22s and 25s are also hot on their heels with about 5,400 and 5,300 respectively, all in DEES. And looks like something going up a vertical today in the DEES because the DEES 22s and 25s have both done 2,780 contracts, 2,783 on the 22s, 2,782 on the 25s. So looks like some sort of vertical action lighting it up today there, listeners. A 22-25 vertical in DEES out here. Maybe someone betting on continued upside here in all things silver. Worth noting on the 21s, that was actually slightly closing paper on the week, so maybe some people taking the upside off. And again, with the skew coming in a little bit, could be people maybe selling some of that upside a little bit as well. This paper coming in and deciding maybe, let's look at the D skew really quickly and see if similar. Yeah, the calls came in about 2 points in D, so that could be upside selling paper. I mean, we mentioned the 21 calls; those are probably selling. Maybe that vertical, maybe a little bit of selling paper too. So maybe some folks fading this rally. Either way, interesting paper afoot out here, Mr. Rock Lobster. I know you do metals. Mostly you do them in the ETPs out there, like your SLVs and your GLDs. Mostly I think when you're doing them, you're probably playing the gold. But this move in silver of late, it's kind of been hard to ignore. Has this been something that's been catching your eye out there of late?
I know we have a couple of guys that look at metal futures in our pro chat room, like mostly palladium and stuff like that. I'm a little, anytime you see a move this big, you already are scratching your head as to why. I mean, is it all dollar? Is it all demand? Is it just people looking for something that's solid because you've got all these zero interest rates? I found it, and if you look at charts of it, it looks like it's all related to when everything sort of went bad around the whole trade thing, right? That's when, all the new trade deal tariffs started kicking in. I guess like mid-July when the Fed basically said, we're not so worried. We're just going to kind of let rates go to zero and it's cool. I think it certainly didn't help things. And ever since then, the metals have gone, totally. I don't know how high they all go. But obviously the move in silver is huge. So, you get up here, and as you get like vol pulled up, but you still have the absolute levels of volatility for silver are really high. So they're not, I would say they're not going away. So interesting trades like maybe, upside 1x2 call spreads or something like that, where you're trying to get, you're like basically, like 17.5, 18.5, or trades like that where all that upside stuff is kind of bid. But I don't see, the hardest part is I don't really see like a top for this because, the whole change in tone of the Fed has made kind of the sky's the limits on the metals again. I mean, we've seen these metal rallies for years when everybody thinks there's inflation and it's all never, the inflation thing's never going to end, or just massive, paper asset depreciation. So from a vol point of view, vol is still very close to the 1 year highs it set a couple days ago. And it's only like a small back off right now. I mean, and the only reason silver's backing off is because what? Because the algos are selling it because the trade news is positive. So I think the fact that the vol hasn't come down yet anywhere close into this pretty hard rally, means that, I think you're going to see there's still a lot more volatility ahead. Because there's just no natural, nobody's selling the juice in it at this level.
A lot of juice to be sold out here. Looking at just some numbers here, D silver, largest one-day dollar and percentage decline out there in just that D's contract. That's again on the news coming in today. Still up on the week, obviously, but today's news is not exactly good. By the way, those of you asking, hey, we saw palladium and platinum. I'll cut off your emails now in that top 5. How come we don't talk about those? They're not really big options stories there. Palladium, for example, doing 13 contracts this week. Platinum a little more, about 1,200. What we didn't see up there, of course, in the top 5 is gold, because gold's getting beaten up quite a bit. We have to look over there really quickly before we move off the metals. A big day for gold to the dark side here. Not exactly the day the gold bugs were looking for out here. The largest one-day dollar loss in gold in about 3 years. Again, that's coming on the heels of not even really substantive developments in the. They just said there's going to be more talks in a few weeks. But that apparently is enough to rally the markets and annihilate gold. We also saw some jobs data coming out of here, out of the U.S., that stronger than expected jobs here. So that kind of 1-2 punch annihilating gold today. Net on the week, gold coming into Showtime is kind of unched. So giving back some of the gains it had for the week. It's off not even 1/10 of a percent, right around 1522 or so. So all the gold bugs out there are still north of that 1500 level, a level I know a lot of you like to look at. And obviously we've blown through 1300 and 1400 over the last few months. So it's a good time to be a gold bug if you get a bit of a profit taking today. Not exactly the end of the world. The vol up, as you might imagine here, coming off the heels of these latest developments out, but not a ton, not a big bump in gold. Like not certainly not what we're seeing, anything remotely similar to what we're seeing out there in silver, which has had just continued to move into the rich portion of the skew curve and getting that vol up as a result. Gold kind of up, but up middling this week. The big trade out here, I said we're at about 15 and a quarter, giving up the ghost right now. The big print, actually the 1600 calls. So perhaps some people thought we were going to threaten that earlier in the week with some sell-offs, people action out there, and the big day actually it comes tied actually about a little bit slightly to today. 4,600 today, about 4,300 on Tuesday for these 1,600 calls. That was the big print out here with about 10,000 total on the week. Slightly closing, but we don't have today's numbers, obviously, so we don't know for sure. And then on the heels of that, it kind of falls off a little bit. We go down to, looks like the 1,500 puts. So not surprising. That's where we're threatening these days with about almost 5,000. The lion's share going up today, about 2,000 today. Again, we're seeing a big sell-off. 1,500 puts lighting it up. That's not exactly surprising. Let's go a little bit farther out to see if anything else strange is dominating the table. And actually, looks like there's kind of a bit of a tie for third place here, pretty close to it, right around 4,200 contracts. The lead goes to these March 1,400 puts with about 1,400, 4,221 to be precise. And then hot on its heels are the 1,700 calls with about almost 4,200, 4,160. All of that coming today, about 3,000 going up today, 2,950. So big action in the 1,700 calls out here in gold today, which is surprising. Maybe someone giving up the ghost after today's sell-off, or perhaps using today's retreat to position themselves. Either way, that's pretty aggressive. Seeing how that's not too far, that's not too far out here. November, those are November calls, by the way, not these November. So interesting paper out here in gold. Mr. Lobster, I know you're more of a gold guy if you're looking at the metals. It's been kind of a weird from a vol perspective out there in gold because it's kind of been dead money. And then lately we've seen the vol get a little bit of a lift. Anything attracting your eye out there in the gold these days, sir?
What has been attracting it is why. So this is I'm not quite sure. I guess we had a little bit of a pop, but vol is not as high in gold as it was in silver. I mean, it's kind of been gently sort of going on this grind higher because I also look at a lot of the mining stocks and stuff. But it feels like gold volatility should be a little higher than it is. And I'm not sure why. Maybe silver's attracted all the dollars and attention, but gold is kind of what I would call like a little fairish to low. Like there's not a lot of premium in it, considering at the beginning of August it was $132, right? So, or at least GLD. So when I look at this, I'm like, I think there's a lot of inexpensive stuff around there. I think the Fed's probably going to cut again. So you're not paying a ton for gold options. Like upside call butterflies are really cheap, I think, relative. You have the Fed coming out in 20 days. You have a little backup right now and even a compression in vol today. And sometimes I think the commodities actually act a little opposite. Well, they do anyway. When they pull back, the vol comes in because they're like, oh, the rally's over, it's dead. And I think that's actually like more of a buying opportunity, to be honest. So, I mean, I would view today and, vol comes in, curve gets a little steeper, like those 1x2s and flies and stuff like that look a lot more appetizing on a day like today.
That it does, sir. You know what? If it was edible, it certainly would be appetizing this week as well. Is nat gas. I mentioned it was up 6% on our movers and shakers on the week, and coming into this portion of the show, actually up 6.7% right now at about 243, almost 244 out there in nat gas land. It's an interesting one to watch out here. Vol, as you might imagine, up pretty firmly, up about a handle and a half, if not 2.5 handles, depending on where you're looking on which contract out here. Not a ton. But there is a ton of paper out here in nat gas, lighting it up this week. OI up pretty strong, up about 6.33%. The big contract, though, surprisingly, we're threatening about a 2.5 level here. And the big contract out here this week are actually the two puts, the two even puts. Looks like paper was actually adding, not closing on those, not with the rally, not exactly scrambling to close out there, actually opening. Maybe they're writing those. It's interesting. Either way, 30,000 and change of the two puts. That's our big print for the week out here in these contracts. These are, I should mention, these are out here in the October time frame. So these don't have too far to go. They have about 20 days to go. Not bad. Over our 2-week demarcation there. 30,000 and change going up, pretty much opening every day this week, opening about 6,000 more. Total about 15,000 going up on Tuesday, 6,000 that opening, about almost 11,000 on Wednesday, about 4,000 that opening, another 5,000 going up today. So size over about 10,000 so far opening net on the week. So opening positioning on the two put strike, which is kind of interesting. Not exactly what I would have expected. On first blush here, two puts also active in pretty much across the board. Out here in November, they're doing about 14,000, close to it, about 3,000 only in D's. But still, that two put strike, not exactly what you'd expect on first blush. You'd think maybe some two halves were lighting it up. And this week, there were some two halves going up this week as well. They were a distant number two, 22,500 going up this week. About almost 14,000, actually almost 12,000 going up on Wednesday, and then 8,000 going up today. Again, slightly, actually it looks like a lot of back and forth paper because it's slightly biased to the opening, but not a ton. So two puts leading the dance, and then a distant second place. Two half calls, which is close to the at the money strike now. You would expect would be leading the dance. If you want to talk skew out here, what's going on out here? The puts were about nearly 2% rich to the at the money, and then coming into this week, they're 5.3%. So that alone is telling us there was some buy-in paper out here on those two puts this week. It wasn't all crushing the bid. It was buying it up because those puts are getting juicy here. And the calls were pretty much flat to the at the money, so there was really no bid to the calls, which is kind of interesting. And then this week coming in, they're actually 1.4% cheap. So a big upside move. Calls coming in. Puts getting bid. That part I get. The calls coming in like that. Kind of interesting, especially considering there was no bid last week. It's kind of interesting. Let's see. Let's go out here a little bit far. Let's go to D's. The D's, the calls coming in a little bit as well. They're about 8% rich to at the money this week. They're 5.2% rich. Also seeing puts get a little bit of a bid out there. So that's kind of making sense. They were 3.5% cheap. Now they're 1.7% cheap. So puts getting bid and calls coming in. It's kind of what we're seeing across the skew here in NatGas. And before we move out of energy, you guys will just riot. You'll revolt. If I don't talk your favorite, so you can save your emails, I'll talk you some your WTI. I know you guys love it. You need it in your lives every week, so we'll hit on it for you. WTI, another week, another rally out here this week. Interesting one this week because, again, we're kind of seeing mixed signals out here. It's always that push-pull between domestic supply and the growing global demand here for WTI, or probably not so much growing of late, which is why, of course, we've seen this weakness out here in WTI. Coming into showtime, it's up about a handle, nearly 2%, right around the 56 level here. And again, we're seeing a little bit of a lift towards the tail end of the week after some surprising numbers on the domestic supply front. We saw the API coming out and surprising people again today, coming in of about a draw of about 10 million barrels, which gave a nice little lift to prices. And we also saw yesterday, of course, the renewed hope of some sort of talks, at least I guess you can say, on the trade war front. That's been weighing on crude very heavily, the global demand, Chinese demand. And that was not exactly a boon to WTI over the past few months. And just the prospect of that also seems to be combining. So the combo of drawing down supplies here in the U.S. and the hopes of renewed global demand for WTI, that combo gives us a bit of a lift here. Coming into showtime here, we're seeing vol up a little bit. Actually, not that bad. Actually, about 1.5 handles here out in some of these near-term contracts. And the big action, 50% coming in that now October contract, 50% of the paper going up there. The big print there, the 50 puts. So people looking to perhaps draw that line in the sand again at the 50 strike with about 19,000 contracts, 8,000 on Tuesday, 8,000 on Wednesday. Those are the two big days. Total of nearly 19,000, a slightly opening. So a lot of back and forth on that 50 put strike here again this week, despite the fact that we're rallying towards the latter portion of the week. Skew really quickly. I don't like to do skew in those nearer. Let's go out a little bit. Let's go out to where there was 26% of the paper that was out here in November. That's a little bit more palatable to me. You got 42 days for that to go. And the skew hasn't changed a bunch this week. The puts were leading the dance. They were about 9.1% rich to the at the money this week. They're 9.7, so getting a little bit firmer out there. The calls 7% cheap to the at the money this week. They're 7.5, so coming in a little bit. Mr. Rock Lobster, I know crude's kind of a mixed bag for you guys. You like when you play it, a lot of your mentees probably go the USO route, which has all of its inherent problems. But WTI is also an interesting one to watch. The vol out here has been fascinating. In fact, we've had our buddy Mr. Russell Rhodes on the show a few times, and he said he's starting to pay a lot more attention to WTI as just a volatility product because it is so volatile, and it's kind of underappreciated, he thinks, and underreported, the moves we get out here. Everyone talks, S&P volatility and VIX and Russell popping and things. Everyone expects that from equity volatility, maybe even the metals, but it's not really talked about a lot in the energy cycle. So is that something you started to notice as well, that, WTI and crude and energy in general, maybe a more interesting place from a vol perspective than you maybe thought about previously?
Yeah, we actually have 1 by 2 people in crude and in CL. I don't look at just the futures as much because my brain can only handle so much at once. But we do have guys that like, 1 by 2 put spreads, buy one and sell two, and they're, constantly working around the 50 line and stuff like that. So that part is, and it has picked up vol wise, and, now we have kind of that 50, 70 range or something. We'll see if it can keep going. But I thought actually for a while, at least in the springtime, I was buying a lot of crude, just USO strangles, and it worked really well because the vol was nothing. I think because of the nature of the product, like you said, you can get really sharp moves in the short term, and it tends to sort of price the volatility relatively low. So if you're looking like at the money vol out to October, it's like a 32%. That's a 2% per day average. It doesn't take much. Like if you get a good oil shock move where that kind of stuff can pay. So it makes an interesting product because, you have those kind of overnight shocky moves, and it's easier to close those type of trades. And again, right now, like vol is really, really, really low for the last 3 or 4 months. It's not the lows of the year when it was, when crude was like kind of trading at a higher price, but you have pretty low volatility across the term structure. And then you have and it's relatively high movement. You're getting, 7, 8, 9% moves over 1-2 week period. So it's like, it's moving around and they're not really charging you a whole lot for it. So, if you're not sort of operating out of the money, I would be more apt to, look at cheap strangles and stuff like that, and you can actually pay for them for 1 by 2s. That's a strategy where you're trying to just get the cost of your strangle lower by trading 1 by 2 put spreads, stuff like that, because it really doesn't look like the price of oil is going to zero anytime soon. So you kind of skew the trade a little bit in that direction, and that can work out pretty well. I think. And I think the WTI worked just as well on that. Just history-wise for me, it's hard for me to just sell calls in any oil product. When I first started, it was like Gulf War I, and oil prices used to do crazy things. So the stain is still on my brain even 30 years later about selling calls.
You were burned once.
WTI.
You were burned one. Those formative years, it's hard to overcome those lessons, right? You learn that stuff, and it burns into your brain, sir. And you cannot escape.
Singed in hard.
But I think you're right. I think the 1 by 2s with the ratios and leaning a little bit more short on the downside. You're right. There's obviously we've seen crude can drop into the low 40s and things, so there is downside there. But I think you're right. Zero going to be kind of hard to approach from a WTI. I think some folks may step in before we get to zero. if that happens, there's a lot of other things going on in the economy. It's like the old selling of the 200 put in the S&P. Everyone says, if you get there, you got other problems to worry about than your put coming back home to bite you here. We don't get a chance to talk ags a lot on the show here, but it's kind of hard to avoid this week. Because, as you mentioned, the bottom 5 of our movers and shakers this week is dominated by the ags. Number 5 was wheat. It was down 1.6%. Then we had number 4, live cattle, down 1.7%. KC wheat down 2.5%. And lumber, number 2, down 3.15%. And corn leading the dance to the dark side, down 3.16%. Of all those, we could talk wheat, but it's not really a huge option story there. Of the two, irregular SRW wheat does more paper, about 60,000 contracts this week. KC wheat, which is have more of a move, but not as much of an option story, only putting up about 13 to 14,000 contracts this week. Compare that to corn, which has done about 300,000 contracts this week. Much more of an options story out there. Corn's kind of like the equivalent of an index option out there in the ag. That's where a lot of the big players are. It's where you can still go out there and see some volatility, see some term structure, have some nice setups. I know a lot of people who've migrated into the corn pit over the years, and you could do so very nicely from let's say a broad equity index mindset, something along those lines, because there are a lot of analogies there. Obviously, the skew, a markedly different beast, but if you can wrap your head around that, you can be off to the races out here. It wasn't off to the races this week, of course, like we mentioned. It was off about 3.16%. Coming at Showtime now, it's down about 2.75% here. Again, you guys can find those week scans for yourself, cmegroup.com/TWIFO. The 360 handle is where we're hovering out here in corn right now, about 359.5, so a little bit shy of it right now. It actually puts us off about 10 handles on the week here. Again, maybe hope that renewed optimism for the trade war can reverse some of this annihilation we've seen in the ag sector of late, but at least for this week, not looking too rosy net here on the week. Vol up, as you might imagine. Let's go out to November a little bit. That gives us a little bit more time. That gives us about 50 days. Actually, the OC contract has about 15 days left to go, so we can look at both of these from a skew perspective. The vol out here in OC is up nearly 4 handles and up about 1.3 handles out here in the November contract. In terms of the skew, let's see. The big paper out here this week, 43% of it coming in the DEES, actually. So let's go a little bit farther out. Let's go to DEES. Follow up about a point out there as well. Not exactly surprising, given what we've seen out there of late. In terms of skew, all this downside, given a little bit more interest, a little bit more action, at least I should say, to the puts out here. They were 4.4% cheap to the at the money. Some folks obviously taking advantage of the sell-off, maybe to hammer some of those puts in D's, because now they're nearly 9% cheap to the at the money, about 8.8%. And the calls getting a little bit of love this week. They were about 5.9% rich to the at the money this week. Now they're coming in at about 7.4%. So bid to the calls, sell into the puts out here, as we're seeing about a 10-handle sell-off in the corn options this week. The big print out here was the 370 calls, so near out of the money calls here. Going out on a limb and say they're probably buying some of those if that's getting all that love to the call skew out here. In total of about 11,000 and change. The big day was Wednesday, 8,600 going up there. The rest scattered throughout the week. Number 2, we've got the 380 puts. So now in the money puts. Kind of interesting. Again, these are out here in Dees with about 11,000 of those as well. The big day also Wednesday, about 9,000 going up on Wednesday. Slightly closing there, slightly opening on the 370 call side. So open into the calls, close into the puts. That could also be some paper coming in, taking some profits on the puts and dumping those, and that could also be why we're seeing the puts come in a little bit here this week. Let's look here. Also action here, 370 puts. So in the money puts, kind of where the action was this week. About almost 11,000 of those. Also Wednesday, the big day, 8,300 there as well. Slightly opening, about 1,600 of those. And then rounding us out here about was the 350 puts. So now slightly out of the money puts here, doing about 10,300. Big day actually there on Monday, 5,500 of those. Net opening slightly of about 1,000 or so contracts here this week. So interesting stuff out here. I know the ag's not exactly your bailiwick, Mr. Rock Lobster, but still an interesting one to watch. And, ag volatility, it's been somewhat tumultuous of late. But, ags, if you're talking trade war, it's kind of hard to ignore the ag story, is it not, sir?
It is hard to ignore the ag story because I know that affected Tyson a little bit. That's a equity, I always try to tie equities to ag, to commodities and stuff like that. I I remember I listened to Scott Shellady. He was talking about, the corn prices going to the moon because of, all the rain and stuff like that. And things are seems like it's kind of chilled out since then. And, maybe not so much overseas demand anymore because of the trade war. So as far as then from a vol point of view, it's kind of getting back to what I call like a little bit more normal area. And it's sort of recovering from what was probably a really volatile time for it. So sometimes when stuff like this happens, it is sometimes you think about stuff is it like a long option, like a long near the money option where you think it's going to bounce, or it's kind of more like 1x2s and selling out of the money options and just sort of letting things go sideways. And it feels like it's, at least also looking from a vol and price point of view, it looks like kind of a sideways thing right now. It's not really, we're not getting the big love anymore. Seems now that the next, whatever the next planting season is and all that stuff is coming around. And those dollars aren't there for it anymore, but the corn prices are down so much from where they were in the middle of the summer. Like all the vol is kind of dead. But again, it looks like more sidewaysy action for a little while. Now, if the trade war truly is sort of calming itself down.
Let's hope your questions aren't calming down, because we love the deluge of questions we get every week. Let's try to answer some of those now with a little bit of your futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/The Options Insider, stocktwits.com/Options Insider, or via questions at theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live every Friday at 3 p.m. Central via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's MIXLR.com.
All right, let's see how many we can get to here in our remaining minutes. This one's right up your alley, Mr. Rock Lobster, so good thing you're on the show here today. This one comes from Derek. He wants to know, what is the best way to play the increasing divergence in volatility between the Russell 2000 and the emini? I'm assuming he means the emini S&P. This is an interesting question. We get variations on this theme a lot. Obviously, we talk about it a lot here on the show. We talked just at the top of the show about the divergence between VIX, which is, of course, S&P volatility, and the RVX, which is the Russell 2000 volatility. Now, the challenge, I think what he's alluding to here, is that, you could trade S&P volatility any number of ways. You can go straight through the straddles and the E-mini or in some of the other S products. You can trade the VIX itself. With the Russell 2000, there's that RVX, but it's an index. It's a quoted index. It's not exactly tradable. So you can't go the direct volatility route if you want. So I'm assuming, Mr. Rock Lobster, that that's what he's referring to out here. So if you had a client, let's say Derek. Let's say Derek's one of your clients over there in the land of the pit. And he comes to you and says, Mr. Rock Lobster, I would like to trade this increasing divergence between RVX and the VIX. What should I do?
Because I think Russell is a little expensive and VIX is a little cheap. So the idea is you are buying options in the let's say you're using the SPY and the IWM. What we did is go let's say 2 to 3 weeks out, and you purchase, some strangles and SPY. And then against that, you sell what I would call meteor type of options in the Russell or the IWM. So not more like an iron butterfly type thing. But what you're looking for is, sort of the vol of one to collapse against your Russell vol to collapse and your SPY vol to happen. And if you do get a runner in one direction, you can kind of hold your SPY because your loss in the Russell should be smaller, right? Because you have your short spreads and then your long strangle. And you have to play with that a little bit to get a ratio that's right, because you only need like one straddle for every maybe 2 iron condors. It's like usually 1 to 3, somewhere around there. And then you kind of let it sort of play and see if that divergence actually happens, or if the Russell does sit around, you get a little action on it. So that is something we've done before. I don't have that type of position on right now because I just mostly have a lot of VIX in September. But that is a way to do it. But I would do it as kind of like a long contract but short spreads where the stuff is expensive, because you have to think about it. Russell's more expensive because people, I think, are waiting for it to pop and kind of catch up with everything else. So that's how I would structure that position.
Well said, sir. Yes, you have to be comfortable playing in either the futures or in the direct indices themselves, as opposed to just trading the vol products against each other, because obviously there isn't one of those. And we've been bugging Sean. We've been bugging those folks for a while. We'd love to see RVX. Mr. Rockloff, did you ever trade RVX back when it was listed? I know it was kind of an infrequent player, but it was an intriguing one. Did you ever sink your teeth into it?
I did not. Unfortunately, I'm kind of a one-trick pony when it comes to that. So I would love to say yes, but I have not.
So you're the reason they delisted it. It's all your fault. So you wouldn't play.
It is all my fault.
You wouldn't play, and they delisted it, and now here we are with no Russell volatility product, all because of you. All right, we got time. I think let's do one more here before we got so many. We probably do a whole question and answer show. Maybe we will one of these days. But then people write in, you didn't talk about our product, so can't win. Let's see. Tea Time. Tea Time wants to know. So, what are your thoughts on the current gold-silver ratio? That's obviously an important ratio out there that's widely disseminated. A lot of the metals folks like to keep an eye on it. Effectively, it means how much silver do you have to trade, how much to buy an ounce of gold, effectively. And so right now, I just pulled it up at CME. It's hovering a little bit shy of 80, about 79.90. So right around 79 to 80, which means effectively you have to use 79 or about 80 ounces of silver now to pay for, or the equivalent of 1 ounce of gold out there, which shows how rich gold is. But, that they may say, hey, well, that's actually a lot. So gold's outperforming silver. But actually, it's the other way around. If you look historically a little bit, that ratio not too long ago, just the middle of July, was north of 90, at 92. So it took 92 ounces of silver to buy an ounce of gold. So clearly, in the last few months in particular, we talked about this, just this last week, you could see it. Gold selling off hard, silver still up on the week. Silver has dramatically outperformed gold over the past couple of months. So that ratio has come in quite a bit. It's come in about 12, 13 points. So that's a big move. That, if anything else, is really just proof there of how just the dramatic outperformance of silver. So if I have any thoughts along those lines, it's that silver has kind of been the place to be of late, and not so much gold. Our old buddy Uncle Mike is probably laughing right now. He has that long-term 2-year silver collar that I've been mocking him about for years now, and it's finally starting to pay off for him. So I guess I need to take my hat off for him on that front. So that's kind of where I stand right now. If you look at it even just from a recent historical perspective, you'll see silver has dramatically outperformed gold. Mr. Rocklobster, is that a ratio that factors into your analysis at all over there, sir?
I would like to say it does, but that's one thing I can't comment on that one, because it's not the gold silver thing is not besides impressing Tucson with it, it's not something I look at much.
It's always fun just to tweak Uncle Mike, though, is it not?
Yes. I'd love to be able to pull that ratio out of my behind and say, hey, look at this. This is where this is. You should be getting rid of some of your silver right now.
You should study up on it just for our next option block episode, just so you can throw it in his face and try to mock him with it. So there you go. Listeners, it has uses for mocking and for umbrage, if for no other purpose there. So yeah, we watch it. I watch it at least. I can't speak for the Rock Lobster, but I watch it out there, Mr. Tea Time, and it's certainly, or Mrs., we don't know. And it's certainly been one to watch of late. And if it continues to decrease there, then I'm looking at this contract here, the DEES contract for that gold-silver ratio. The low of it was 70.9. So right around a 71 seems to be the near-term low for that contract there. So it can get down to about the low 70s there. So if we start retracing those levels. Certainly interesting times out there in the metals space. Unfortunately, speaking of time, that's all the time we got for this episode of TWIFO. I want to thank my cohort, the Rock Lobster, here for joining me today, talking vol across a broad spectrum of products. We got him out of his comfort zone a little bit. By the way, you can send all your angry mail to him. He's the reason that RVX was delisted. He refused to trade it. But that said, if you want to send him some nice letters too, or perhaps you want to sign up for some mentoring, Mr. Rock Lobster, where should they go? What should they do?
Go to optionpit.com. And Mark has an event next Wednesday on butterflies. You can trade butterflies in commodity options. You can trade butterflies in equity options. They are an equal opportunity position.
Yes, butterflies, equal opportunity offenders or perhaps profiteers, depending on how you use them. Hopefully you use them correctly. If you want to learn more, optionpit.com. Check out their webinar coming up next week for how to use butterflies. Butterflies, we see them go up all the time. The metals, they're really popular in the metals, the equities as well. They just, for some reason, there's someone out there who really loves their ratio verticals and butterflies out there in the metals and gold. So you can apply them across the board. So learn the strategy, learn how it works, and you can apply it on your product of choice. Speaking of your product of choices, you can analyze them all over there. CMEgroup.com/TWIFO. That's where you kick the tires and light the fires on the Quick Strike as well. If you want to upgrade to the pro version, then head on over to bantix.com. That's BANTIX.com or Quickstrike, QUIKSTRIKE.net are the places to go. And of course, our buddy Sean couldn't be here this week. He's the one you want to bug, really, about bringing back RVX. And the place to do that is FTSE Russell, FTSERussell.com. Or you can send him an email, S. Smith. He said it before, smith@FTSERussell.com is the place to reach out to him. I know some of you had some interesting questions recently about the specs and AM versus PM settlement out there. So I passed all that along to him. There's some interesting developments on that front. So we shall see. And of course, on behalf of the Rock Lobster and our buddy Sean and Nick who's floating around out there and our friends at CME and indeed myself, I want to thank all of you out there for downloading, streaming, subscribing, and of course for sending in so many questions. Keep them coming. You guys keep us on our toes, and we love it. And we'll see you back here tomorrow for Volatility Views, and then right back again next week on Thursday for more of This Week in Futures Options.
This Week in Futures Options is brought to you by Quick Strike, options pricing and analysis software. Quick Strike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. Quick Strike has you covered, with market data reports ranging from open interest to the term structure of volatility. Quick Strike is the perfect addition to your trading toolkit. Learn more about Quick Strike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. Investors in the U.S. and around the world are using FTSE Russell indexes to benchmark their investment performance and create investment funds, ETFs, structured products, and index-based derivatives. Many Options Insider Radio Network listeners will be familiar with the Russell 2000 Index. Russell 2000 futures and options are currently trading on the Chicago Board Options Exchange and CME Group. For more information, please visit FTSERussell.com, CBOE.com, and CMEGroup.com. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.